Well, today, can you have too many credit cards open? Today, we're going to take a look. Stay tuned for Prudent Money. Good afternoon and welcome to the Prudent Money Radio Show. I'm your host, Bob Brooks. Thank you so much for joining me today. You know I do appreciate it. Well, today we're not taking questions. And if you do have a question for me, there's always a way to get those questions answered. Just go to the website at www.prudentmoney.com. Send a question to the Ask Bob section, and we'll get that question answered for you. Love getting questions. And I love taking the opportunity to answer those for you. So that's all at prudentmoney.com. Or you can simply go to info@prudentmoney.com and send a question that way as well. Lots of ways to get those answers, and you can do that at prudentmoney.com. Well, today we are going to go over Ask Bob questions, and I want to start off with one about credit cards. It says, Dear Bob, background. Between us, we currently have 4 credit card accounts. We do not maintain a balance on any of them, paying them off each month. We have not been happy with customer service for the cards we have and are considering getting a Discover account as we have heard good things about them. So our questions are this. Number 1, does having too many credit card accounts hurt your credit score or have other downsides? Is there an upper limit? Credit and what are your thoughts on the first question? Well, it really depends, and I hate to give that answer, but it depends on what is on your credit score or your credit report, because your credit score is a reflection of every piece of good and bad news on your credit report. I'll just say, in general, as long as you don't keep a balance on them, keeping a lot of credit cards open, it's not necessarily a negative thing. I don't know that there's a magic number, once again, because of whatever else, positive or negative, is on your credit score, on your credit report. So let's give an example. If you had a situation where you had a lot of negative items on your credit report, but at the same time you had a bunch of credit cards open, it might be that all those open credit cards will be a positive thing for your overall credit report. One of the things, though, that you're looking at with credit cards is the credit limit and the balance. This is why you want to keep your credit balances low, because what the credit reporting system looks at is the credit utilization rate. If you have 40, or let's say $50,000, or no, let's make it easy. Let's say that you have $10,000 on a credit card and you're using $5,000 worth of debt against that credit card limit. Your credit utilization ratio would be 50%. That's going to be a negative because that's a little bit high for credit utilization ratio. The scoring system looks at credit utilization ratios of about 33% and below is a positive. Actually, the closer to zero that you get, the more positive it is. So if you have all these credit card accounts open, and let's say that you have a combined $50,000 worth of credit limits and you have no debt against it, that's going to be a hugely positive thing for your credit score. Very, very positive for your credit score. That's zero credit utilization ratio is about as good as you can get. If, on the other hand, you had $50,000 worth of credit limits and you had $40,000 worth of credit in the form of debt against those credit limits, that's not a good thing. That will bring your credit score down. So from what you're describing, I don't think that there's really any downsides to credit card accounts. There is a downside, though, to customer service, as you put in your email. Customer service, I don't know what has happened, but ever since the pandemic started, customer service across the board has just gone downhill. I don't know that I have an answer for that. The second question is, does having an account and not using it, keeping the cards in safe deposit box, for example, have negative consequences? They only have negative consequences when you don't keep a good eye on them. And what I mean by that is I used to have one credit card that I didn't use, and it was in a desk drawer somewhere. And I'll never forget, I got a bill for $45, and it was for a rewards program that they were continuing to charge me for, even though I wasn't using my card, which they had every right to do that. Had I not caught that, that $45 would have turned into probably an additional $35 on top of that because I was late because I didn't know I had a payment. And then if I went another month, they would probably send me into collections over, $100 worth of fees that I didn't know that I had. I didn't know that I had the original rewards program fee to pay. So the best thing to do to fix that problem is, and just about every credit card site has this. You go online, go to your account, and put alerts on your credit cards to alert you if someone is charged something onto your account. If you're not using it and you see that there's $100 charge, that means someone's got your credit card. That one, or another one would be balance alert, payment alert, anything like that, so that you're notified if anything is happening with those cards. So if that helps, that's I think, but I do think you're in good shape. And of course, if you have credit cards and not using them, you might want to try to use them every once in a while. Pull them out and charge gas on them for a month and then pay them off. That cannot hurt anything. But here's the thing, is that if you're 730 or so and above, your credit is good. There's no need to try to get to 800. I mean, it would be nice to have an 800 credit score, but as long as you're sitting at the top percentile, you're in good shape. Dear Bob, I heard that a few mortgage lenders went out of business, and it started making me think, are we heading into another housing crash? What is your opinion? Well, it's interesting when you compare the real estate mania of 2000, now let's say about 2005 to 2008, excuse me, to the real estate mania today. I mean, they're two totally different situations, except for they have one thing in common, that they are both manias fueled by the notion that home prices are continuing to go up and you can make money off of it. In the prior to the financial crisis in 05 to about 07, 08, real estate was going up and people were flipping houses. And a lot of this, well, I'll get to that in a minute. So you had a lot of houses being flipped. This one is different because you had sellers with the ability to sell and get way above the asking price. You had a bidding war going just on about every property. So there was different ways to make money. The big difference between the two is that you had very loose lending. You had hardly any restrictions on lending, and so just about anybody was able to get a loan. Plus, there were some fraudulent things going on to where people were lying on the applications and nobody was checking it. So you had that going on one side, today you have much tighter lending standards, but you have people with we have from a standpoint of credit scores, people have very good credit scores today, and you also had the money to invest into the house, unlike back in before the financial crisis, where people were borrowing up as much as they could to get a house. So if you look back at what happened in during the financial crisis, is that these loans were toxic, bad loans to begin with, and you had a high default rate, a foreclosure rate going, and these adjustable rate mortgages. The whole system was built on not on a strong foundation, but we'll say sand, and you had a collapse of the housing market. This time around, you have a more of a supply and demand issue where you have great demand, very little supply, which has run the prices up in real estate. So two totally different situations. Add to that problem, and what has really shut the real estate markets down to a certain extent, at least slow them down, maybe not shut them down, it's a little exaggeration, but slow them down. You have a scenario where interest rates have gone way up, and now buyers are saying, yeah, at 3.5%, I could afford this house and afford the premium I'm going to have to pay. At 5.5%, not so much. Not able to do that, and so they're backing off. People are canceling contracts. Deals are falling through, and so you still have a supply and demand issue. But I think what you're going to have is a stagnant market, and you're going to have prices forced to come down to some type of a market equilibrium. But I do not think that you're going to have any situation like you did in '08. Now, to get back to your question, you did ask about mortgage lenders that are starting to go bankrupt. There was an article on Yahoo Finance about this, which is what you may have seen. The title of it is U.S. Mortgage Lenders Are Starting to Go Bankrupt, which is a little bit of a sensationalized headline because that's really not what's happening when you compare it to '08. How this one factor could be triggering the worst surge of failures since 2008. Now, once again, this is a very sensationalized headline that, most people, and I'm guilty of this, will read a headline and act as if they read the article, which is not the case. There is a certain element of loans. You could compare them to the subprime loans, which were loans that were made, mortgage loans that were made back in '05 to '07 to people with bad credit. And subprime loans were loans that had a good chance of going out of defaulting. So this is today's version of a subprime, mortgage, and it's these what's called non-qualified mortgages. A qualified mortgage is one with the tight government lending standards. A non-qualified mortgage is for someone who couldn't get a qualified mortgage, so there's a credit risk there somewhere. They use non-traditional methods of income verification and are frequently used by those with unusual income scenarios, self-employed, have credit issues, making it difficult to get a qualified mortgage loan. So a couple of lenders went out of business: First Guarantee Mortgage Corp and Sprout Mortgage. First Guarantee Mortgage, once the lending volume dropped, left the company with more than $473 million owed to creditors. So you have First Guarantee, who went into bankruptcy. Sprout Mortgage, which did a lot of these non-qualified mortgages, just abruptly shut down in July. A little bit like Lehman Brothers. Of course, Lehman Brothers was the first or second largest investment bank in the world. Ran out of money and went under within 24-hour period. I'll never forget that. That was during the financial crisis. This Sprout Mortgage, smaller version, of course, of Lehman, but probably didn't make much of the headline news. Just eventually shut down this past July, and that's typically what happens with mortgage companies. And I think you'll see a lot more. But you got to look at, the question is how much, what kind of a percentage of the mortgage industry are these non-qualified mortgages? And it comes down to 4% during the first quarter of 2022. So don't think it's anything to worry about. But once again, in 2005, 6, and 7, whenever you want to say that the housing mania was really started, you did have lenders starting to go out of business, and it started off slow, then it really picked up, and you had a Countrywide Mortgage went down. I mean, the big ones went down, all because of these toxic loans, which is what you're not seeing here. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. I'm not taking questions live here on the radio, and I am taking them on the website. PrudentMoney.com is where you go. You know the drill. Go to Ask Bob, send them in, and I will get it taken care of for you. That's off the website, www.prudentmoney.com. Today, I'm taking a few minutes to read Ask Bob questions. And I love this question. Dear Bob, I am working on my retirement plan. Love that. And I'm trying to come up with the right amount of money in cash for emergencies. Love the forward thinking as well. What formula would you use? It's funny. One of the things I've learned through 30 years of being an advisor is that people look at emergency funds a lot different. They all look at it differently. Some, I know one couple who carries $150,000 in cash in their bank, and they do whatever they have to do to keep that level. If they spend some of it, they build it back up. Not a right or wrong. It's what you're comfortable with and what leaves you at peace. But I do believe, instead of having, if you're going to have $150,000 in there, I think it's important to have a reason for having $150,000 sitting in cash. And so there's a lot of different ways you can allocate money. So I'm going to give you a list to kind of choose from, and then we'll go back and give you a scenario. There is the dreaded home repair. And I got to tell you, and this is just my bias, I think if you are really any kind of a homeowner, every homeowner, I believe, needs to look into getting a home warranty. Depending on what kind of coverage you get, it's going to cost you, I don't know, anywhere from $50 to $125 or so a month. But if you have a water heater go out and that covers it, that's great. Now, there's some of these repairs that it's not going to cover the whole thing, which tends to be frustrating. But for the most part, I'm a big believer in insurance to begin with. I like to cover things and make sure that they are covered. That gives me peace of mind. The next thing that I would cover is a down market. So if you are covering your expenses by, let's say, $25,000 is coming in from your investments, $25,000 is coming in for Social Security, making a total of $50,000. I would have 1 year's worth of expenses covered by the investment money in the savings account as well. So let's say that's $25,000, and that's there just in case of a down market. Inflation. I look at inflation a little bit different than the 4% rule, which goes up and down with inflation. I think that you put a marker in your plan for, let's say, 2% inflation, which probably it averages about 3.24%, but that's over a very long time period. But I'm comfortable with 2.5% max. And to cover anything that is out of this, not Social Security, because Social Security has a cost of living adjustment. So anything above Social Security's cost of living adjustment, which, by the way, could be as high as 11.5% for this next year, which is pretty good. And the $25,000 that's covering those expenses, you kind of got to you got to look at your, especially, today's time, you have to make sure that you're monitoring your spending, monitoring your expenses really close. But I would dip into the emergency account to make up the difference if you are running higher in expenses than what you are bringing in. And I like 20% of non-Social Security expenses to be covered in an emergency account, which would be about $5,000. If you want maybe a vacation fund, that'd be another maybe $5,000. Healthcare, deductibles for a year. Definitely make sure that you cover the out-of-pocket money, which is about $8,000, let's say. And then a car repair. You have a transmission that goes out, anything serious, new tires. $5,000 might be a little too much, but that's what I usually recommend for having for put back for a car repair. So if you add all that up, it's about $53,000 worth of cash that you would have back in an emergency fund, which kind of makes sense because that's 1 year's worth of living expenses. If you think about it, between the $25,000 worth of investments and the $25,000 worth of Social Security, and no, I'm not concerned about Social Security going anywhere, at least for the next 75 to 100 years. I do think that they will get that fixed. That's a whole nother topic. But it's interesting how that came out to $53,000. Now, keep in mind, if you have not gone out and checked savings rates, you need to do so because they were way much higher than maybe when you checked last year. And there's a couple of ways you can do that. Of course, you can check your bank and check your credit union and that kind of thing. You may or may not get the best rates there. The online savings accounts are probably your best bet, and you can go to a bankrate.com and see who's paying the highest. Just make sure it's a convenient way, that it's FDIC insured, and that you have all those bases covered. Think of retirement. A final thought is a three-legged stool. You have income payments, which is Social Security, maybe a pension, maybe annuity payment. You have payments coming in from your investments, and then in your investment accounts, and then you have cash. And you need really all three to have a successful retirement. Hey, this is Bob Brooks. If you got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time. Keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.